Let's pick up the discussion further. We've got Anshul Saigal joining in on the show right now to talk about how the trading day ahead is going to be and what his thoughts are on the markets. Anshul, hi, good morning. Good to have you on the show as always. Anshul, we were just going through Bajaj Auto's performance. While it's been a stellar quarter for them, both in terms of profit as well as the revenues, no doubt. But the fact is that this has been one of the best performing two-wheeler stocks amidst the entire pack, almost a 60% appreciation already so far this year. Do you think the best is behind us? And you think all this positivity in terms of earnings is already baked into the stock price?
Good morning, Aisha. Thanks for having me. Yes, it's been a stellar performer, not just this company, but this pack overall has done exceptionally well. And we have to bear in mind that the underlying demand in this space had been weak for the longest time. And in the last 1.5 years, this demand has really picked up. And that is getting reflected in the stock prices. Now, after seeing such a rally where many of these stocks are up nearly three times in the last 1 to 1.5 years, and bear in mind that these are not small mid-cap stocks, these are all large-cap names. Having seen such a rally, one would have to temper expectations going forward. Also, valuations seem to bake in most of the upsides in earnings that we are anticipating in the years to come. And that is why we see the stock prices being where they are. I wouldn't be as bullish as I would have been, say, 1.5, 2 years back on names like these. Of course, this is a space which will continue to see tailwinds in demand. We are seeing, incomes rise in the segment which caters to this demand, and that will continue to reflect in earnings. But as you rightly mentioned, most of that is already baked in.
Where are you picking your spots? They say that when there is sale in the market, it's a good time to buy. And I always tell our viewers that imagine you get up in the morning and suddenly there is a 15% drop in gold prices. Won't you buy it? You would. If there's a 15% drop in a mobile phone price, won't you buy it? So what's wrong if stock prices are going down? So if that is the spirit that you should buy at the fall, Anshul bhai, where are you picking your spots?
Good morning, Nikunj bhai. Always a pleasure to speak with you. I can tell you that there are multiple opportunities in the markets. It's just a question of overlapping that with what's going to happen in the canvas as a whole. So when you're making a painting, your painting can be only as good as the canvas. Now, what I mean by that is that if the markets themselves crack because they are very expensive at this moment, then all stocks will crack, even the ones which are reasonably priced just now. That will, of course, happen. But as an investor, we have to bear that volatility if we want to make returns in the long term. That is the price of making returns in the long term, which is volatility. Having said that, I should tell you, footwear, that is a space which has been weak for nearly 4 or 5 years, to the best of my knowledge, and that is getting reflected in even stock prices. I think that stock prices there are attractively priced at this moment. Look at some names in pharma. I see companies which are likely to grow 35 to 40% over nearly 3 to 5 years, and where margins are likely to uptick from here, and stocks have gone nowhere. I think that is a space which will be quite attractive going forward. I see opportunity, of course, less so in manufacturing and capital goods. There are turnaround names even in that pocket which have not done much. The stocks haven't done much. That is where opportunity is. But as I said, banking and finance, again, that is a space where growth is really not priced in multiple stocks, whether PSU or private. That is where we find opportunity. We've got to paint this painting, but be wary of the canvas. If the canvas itself is likely to go down, which is the markets, these names will also feel the volatility. That's all right. We'll buy more.
Fair point. So I'll pick up some spots here. Pharma. You said that you can see companies which can grow for 30 to 40% for next 3 to 5 years. Where do you see that kind of an compounding? Because everybody say pharma is defensive. I always say pharma is the biggest cyclical because the price volatility is so high in generics that it behaves like a commodity.
That's right. There are distributors of pharma companies which are actually quite, on a tear in terms of growth. This is a space where the sector is quite disaggregated, not really consolidated. That consolidation is the way forward. We're likely to see significant consolidation in pharma distribution as we move ahead in the next 3 5 years. And the larger players will get many of these smaller players to consolidate with them. The benefit of doing this is that smaller players don't have the wherewithal to add as many SKUs as the larger players have. And then it becomes a win-win for the smaller players to get accumulated by these larger players. On account of organic growth, as also this consolidation, many of these companies will actually rise quite meaningfully in terms of earnings. And because of consolidation, we are likely to see even margins expand in many of these companies. So that is one space I find quite attractive at this time. Of course, it is not a pharma manufacturing space where you'll see 30 to 40% growth, but in distribution. But I think that again is a very attractive space to be in. Pharma manufacturing as well, the API space, some of the CDMOs, you will see breakout growth over there. It may not be 30 to 40, but definitely in the range of 20 to 30, we are likely to see. With the regulation changing in US and demand for Indian CDMO players rising, we will actually be surprised on the upside in terms of growth. Pharma is quite attractive at this moment.
Okay, point taken. You want to take some of these names of the CDMO players, etc., that you're talking about, Anshul, and separately, if you have been tracking SRF closely, because UBS came out with a note this morning and they have downgraded the stock and saying that there could be some negative surprises ahead.
Uh, Anisha, I would refrain from taking names because I may have interest in these names, and it's not really good for me to really talk about that on TV. Regarding the company that you mentioned, I've tracked this company over many years, and they've done exceptional work in fluorination chemistry. Of course, there comes a time when companies need to consolidate their uptick in valuations. Earnings need to catch up. And it is just that phase in this one company where earnings are just catching up, also consolidating for some time. They're likely to consolidate over the next, say, 1 odd year. And as we know, if earnings don't grow, stocks go nowhere. We could well see that phase play out in the name that you just mentioned.
Okay.
So that's how I would put it.
Okay, so Vodafone idea headed. The worst is behind, the best is yet to come. That is what Mr. Birla seems to be indicating. At 9.5 rupees, is it worth the bet?
Nikunj, in this space, one thing that is very clear is that ARPUs have bottomed for the sector as a whole, and we are likely to see price increases going forward. I remember that ARPUs had bottomed somewhere close to 125 rupees, and they had peaked in the previous cycle at 200. They kept coming down, and they came down all the way to 125, and we're well on route to rates higher than 200 at this moment, which cannot be anything but good for this sector as a whole and this company in particular. However, one has to keep in mind that the competitive dynamics in any sector will determine how one company does over the long term. And in this space, what is critical is how much capital expenditure you incur in adding capacities, which is in essence a function of what is your scale. Now, if you look at this space as a whole, there are really three players who are competing for space in this space and competing for market share, that is. And the of the three players, the top two players have significantly higher scale. market shares in the range of 35 to 40%. As a result of that, they have greater capex availability because cash flows are greater, and their network becomes better than the third player. The third player, as a result, lags in how its network plays out. And that reflects over a long period of time in the cash flows, the relative cash flows of that company versus the top two players. As a result, it will in effect reflect in the stock price. And so I would be, if I was taking a bet on a name like this, which is a relatively smaller player in a large space, I would look at it as a lottery where I will not put substantial monies there. Of course, we know that the balance sheet is really not squeaky clean here. I would take a small bet, and if that bet really works for me, then I make money. If it doesn't work for me, then the money that I lose, I don't really fret over it too much. So that's the setup that I have in my mind for situations like this, and maybe this situation in particular.
What's interesting, in the last couple of days, the AMC stocks have made a comeback. HDFC, Nippon, UTI, AMC, and the story has been very simple. Indians are investing, their savings are diversifying, SIPs are picking up, equity commissions are strong. SEBI was supposed to change the TR ratios. Thankfully, that has not changed in favor of AMCs. And interestingly, PMS, which were getting lion's share of inflows or market share away from the traditional HNI investors, that also seems to be narrowing down in favor of mutual funds. So this year, Nippon Life, it's just that when you look at the data and you say, oh my God, I mean, how could I miss it? There are such easy trades at the beginning of the year. Aditya Birla AMC, 60% up. HDFC AMC, and 50% up. Wow. Anshul Bhai just says that, okay, here's 2 plus 2. SIPs means more money for AMCs. And stocks are up 50%, and 50% in this year. While we may do a lot of, macro analysis of dollar index and China and Korea and semiconductors and cycles and EBITDA and margins, here is like a simple half volley, which is that SIPs are picking up, AMCs will make more money, and the stocks, even in a raging bull market, have given you a 50% return. Is there still money to be made in the AMC stocks? By the way, do you regret moving into this new role because you were with an AMC? Imagine what would have happened.
Nikunj bhai, I'm very happy in this role, and there are various ways to make money in the market. Just like if you're on a dessert table and there are multiple desserts, you don't have to eat all of them. The ones you like is what you choose. I'm very happy for the peace of mind and freedom that I get in my investing in this role. Having said that, I couldn't concur with you more that this is one space which was a half volley. I still remember when the TER ratio fear came early last year, that is 2023, sometime in March or April. HDFC AMC used to trade at $1,600, and it had fallen from nearly $4,000. That was the level of fear which this space had, was absorbing at that time. And our belief was that if this TER fear actually does play out, then most of the downsides are already priced in because the stocks have corrected in that fear by so much. If it doesn't work out, then the upsides are material. These are companies which make over 100% ROICs, highly, profitable businesses where investments are quite limited in the businesses. And we all know, like you rightly mentioned, that Indians are financializing their savings, so that kitty will continue to go up. In that setup where expectations were so low and where markets were doing well, Indians were investing more, SIPs were going up, it was really a no-brainer in a name like this, or multiple names in this space. Much of that has already played out. HDFC particularly is 3x from that price. Many of the other names have done very well. In the current year, these stocks are up 50-60%. To expect that something similar will happen going forward will be an overstatement. I think that one should temper expectations going forward. Just like I said earlier, there are on a dessert table there are multiple desserts to be had. At this time, there are more attractive opportunities in the market. This is not the space that I would put a chunk of my money in at this moment. It's a great business, but most of it is priced in.
Taken
It changes. And I don't think, Anshul Bhai, there's a trade in Trent and Titan just because Mr. Noel Tata is going to be part of Tata Sons. I mean, these are independent businesses which are doing well irrespective. Would you agree with it? Because last week we saw a movement in Trent, a spike in Indian hotels, a big uptick when it even comes to, Titan.
Nikun bhai, when these events lead to such sort of moves, there are opportunities to sell, not to buy. Because nothing in the fundamentals of the business has changed. In fact, in case of Trent, Noel Tata was always the chairman, the person running the business all this while. His becoming the chief at Tata, the Tata Trust really doesn't change much as regards the business for Trent. It continues to be a great business. It's run very well, and that aspect of the business is priced into the stock price. The stock trades at north of 50, 60 times EBITDA. Where is the room for that multiple to expand? And so any spike that happens because of events like this, for smart investors, these spikes are times to really sell, particularly in names where valuations already price in much of the upside. Having said that, I must say that, like you rightly said, you have to give credit to this business, this group. Just like as we grow up and in our journey of an individual where you've created enough wealth for your own self, in the latter stages of one's life, one really gives back as much as is possible to society. Tata Sons has a long history, is an old group, and given where they are in this phase, they're giving back so much to society. Ask a new company, a new unicorn, whether they're going to do something similar, and you will not get a same answer. You will not get the same answer. The answer will be quite different. So it also depends on what stage in your growth journey you as a company are, and how much you've got from society, and how much you want to give back as a result.
Taken. Anshul, the other talking point in the market is how Hyundai IPO has, the response from retail and HNI has been really soft so far. We haven't seen much traction. Of course, it's a large IPO, so it'll suck that much liquidity out of the system. But what's your take on Hyundai? Should one subscribe or avoid?
Anisha, is that question for me?
Yes, Anshul, the question is for you.
Okay. In general, I'm not too much of a fan of IPOs or investing in IPOs. No one has any, interest, or I should say, no one has the incentive to really leave money on the table, not the promoter, not the investment bank. So mostly, many of these IPOs are priced fully. And we have seen also in history that once the IPO lists, you get better prices in future in many instances. Of course, there will be exceptions, but in majority of the instances, that really happens. I'm in this particular case, it's a large company, very well respected in India, and even if one wants to invest in this business, one will, one can do that, but over the long term, you'll get better prices. So I'm on the sidelines.
Okay, on the sidelines, at least when it comes to Hyundai. Anshul, so good having you on the show. We'll let you go on that note. Thanks as always for taking the time.
Thanks. My pleasure, Aisha.
Okay, the pre-open rates are...
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.
Hyundai Motor India Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of rupees 1,865 to rupees 1,960 per equity share of face value of rupees 10 each. The anchor investor offer period opens and closes on Monday, October 14th, 2024. Offer opens on Tuesday, October 15th, 2024. Offer closes on Thursday, October 17th, 2024. For risk involved and other details, please refer to the red herring prospectus, which is available on the website of the company, SEBI, BRLMs and the stock exchanges.